traders, it's Chris Weston here, Head of Research at Pepperstone. We're going to go through the markets. It's a fantastic, fascinating time now. I mean, we can talk about geopolitics, but there's so much going on in FX markets at the moment. I think central banks are right at the heart of that. The core thematic that we've got at the moment is buy hawkish, sell dovish, and if you match those two together, you've got some outrageous trends that are taking place in the market. Yeah, we're all fraternising over about the May meeting. We've got a whole raft of different central bankers from the Fed who have been given their view, and they've made it pretty crystal clear from what we heard from Powell that they're looking very strongly at a 50 basis point hike coming through in that May meeting. The interesting thematic as well is that they're going to announce quantitative tightening. Now, the best way to think about quantitative tightening is QE in reverse. Now, QE was designed to bring real rates lower. It was designed, therefore, to boost asset prices by effectively taking duration out of the market and pushing people out of the risk curve. And ultimately, what we're going to see is caps every month, and we're going to hear that in the May meeting. So effectively, the Fed are going to come out and tell the market that we are going to cap any kind of bonds that are maturing each month, and we're going to cap it at a certain level. And anything above that level, we're going to go out and actually reinvest those proceeds. So the balance sheet should fall by a set amount each month over US Treasuries and mortgage-backed securities. Whether asset prices are going to change on the back of that is obviously yet to be seen. But I think let's go into the markets. Let's see what we're seeing, because there is some outrageous trends. I talk about buy hawkish, sell dovish. There is no better place to see that than against the Japanese yen. The yen has been getting smashed from pillar to post. No one wants the yen at the moment. Japanese pension funds are searching out for yield. They want yield across the world. They want it in the US, they want it in Australia, they want it where you can get that carry coming through, and whether that's on a hedge basis or an unhedged basis, you are getting plenty of yield differential. So, when the Bank of Japan come out and confirm really that they are, and cement this idea that they are the most dovish central bank, followed by the Swiss National Bank, followed to an extent by the RBA, although the market believes that they will change their tune in June, and also the ECB. And then you've got this sort of coordinated chain of effectively hawkish, dovish to hawkish situation where, you can look at who's at the top, but certainly the Fed is now very much in focus with 50 basis point, which we can look at in a moment. But have a look at what we're seeing in Japanese yen, Aussie, Kiwi, absolutely flying. We can see those on the charts. Let's go to the charts, have a look at what's happening in Aussie yen, because this is an outrageous move that we're seeing. And I say outrageous because I've got this on a weekly chart. I'll just put it on a daily chart, but you can see there's just been an absolute trend follower's dream. There's no reason necessarily to be going short. There's no topping pattern that's come through. If we are going to see a move, it's going to be because the price has been extended. I think you look to buy pullbacks within that bullish trend. The same with Kiwi dollar. A lot of the yen pairs are all doing the same thing. And the question is which one do you go for? You just go for the higher beta one, which is the Kiwi and the Aussie in that situation. But when we see proper reversals playing through, it doesn't happen in a market like this. We need to see a topping pattern play through, say like a head and shoulders pattern, or something that gives us a belief that we're going to see a genuine collapse other than just people buying into weakness that we're seeing there at the moment. But the Aussie yen is just absolutely flying. The hardest part for trend traders, for momentum traders, is how on earth do you hold on to a move like that when you're in profits? For macro traders, these are the kind of moves that you need to make once every blue moon. You need a couple of these a year, and you need to hold and extract as much as possible. This is where having a rules-based trading system can actually be incredibly advantageous. Rather than take profits just because you're sitting on a nice profit and you're trading your P&L, effectively you're actually holding and you're closing the position when your rules-based situation, maybe the 3-day crosses back below the 9 or 8-day exponential moving average, or whatever that exit strategy is going to be. Having a rules-based system will mean when you're trading these momentum moves is that you get out at the right time rather than just because your P&L is looking pretty rich at that situation. Anyhow, let's go straight to the bond markets. Let's see what's been going on there, because I think this is screaming out quite an interesting message. And the reason I want to go to the bond market, because if we have a look at the correlation coefficient between gold and the US bond market at the moment, certainly real rates, I'm talking about inflation adjusted bond yields, nominal treasuries adjusted for expected inflation. You can see here the 20-day rolling relationship between real rates and gold effectively is negative 0.8. So what we're saying here is there's a very, very strong statistical relationship at this point between gold and what's happening in the bond market. And generally speaking, the reason we know that is because when real rates are falling, it's making gold more attractive on a relative basis. When we see real rates moving higher, people see a better opportunity in the treasury market, and effectively they look to sell gold in that situation. So we can see from this bottom pane, you can see the relationship, and I've looked at it on a 20-day rolling basis in value terms. And the other thing you can look at is on a basic correlation matrix, which I've got here on the Bloomberg terminal. So I'm looking over the last, since the 9th of March. So it's a pretty short-term time frame. And I'm having a look at the correlations between some various inputs against the gold market. One being it's moving tick for tick, 0 being there's absolutely no relationship whatsoever. And we can go across here and we can see since that period, it's a little bit longer term than what we saw on that one, negative 86. So the strongest relationship, we can look at S&P, we can look at 5-year rates, we can look at VIX, inflation expectations. The strongest relationship statistically is against the 10-year real rate. So you can see that is really influencing my decision about where things are going. If you have a look at 10-year real rates, you can see we've effectively gone from negative 110 up to negative 52. So real rates are becoming less negative effectively. So that's it's a bit of a headwind, I suppose, for the gold market. That's something we do need to consider. And I think that's probably putting some upside in the dollar, specifically against the yen. The interesting thing is if we go back in time, we go back out through history, we can go back to, say, the 1979, 1980 period where we saw oil prices really going through because of tensions that were going through the Middle East. It wasn't until 1981 that equity markets really plummeted. And why was that? It's because we saw real rates going positive. Okay, so we've got real rates at the moment at negative 52 basis points. The moment that I think, if this was to go, negative or go to negative, we've got a bit of a way to go. I think that would be a significant development for the market. I think the Fed wants to see real rates moving higher. I think that's where we get the tightening of financial conditions playing through. So you can see they're heading up. It's interesting to see why, given that correlation that we've seen, that the gold prices are not lower than where they are at the moment. Let's have a look at the gold price. So we've seen that relationship playing through. In fact, I'm going to just show you one other chart, which I think is quite an interesting one. Okay, so this top pane, we can actually see those real rates that we just talked about there. We can see negative 52 basis points, and we can see we've overlapped the gold price there. We've got real rates against the dollar in this pane here. But what I'm going to do is I'm just going to flip this up one here so you can just see the relationship a little better on the classic overlap. And you can see that for a large period between 2019 and 2020, there was a very strong relationship. That broke down significantly through 2021. We've kind of just resume that. Real rates are probably overshot a little bit relative to the gold price, but you can see that statistical relationship, and you can see that visually now when we overlap the two together. So that's something that we are watching very closely, is what happens with TIPS or real inflation adjusted bond yields. I think that's really where the driver of gold is going to come from. So again, if this continues to move higher, and we can have a look at this on TradingView. If we go to our TradingView charts, I've actually got this in my watch list. Where is it? Let's go to fixed income, and the code for that is this. Is actually a day lag, but you can see here that is the code effectively. If you want to get real rates, you can go and bring that down. But it's got a bit of a lag, a couple of days, unlike Bloomberg, which you can see there. But that's really, you can get real rates and bond rates on TradingView, as I show there. Okay, let's go and have a look at the how that's all affected the gold market, because real rates moving higher has weighed on what we've been seeing in gold, especially in US dollar terms. There you can see we're just trading sideways at the moment. We're waiting for the market to break. I think if we get a break of 1911, it's not giving me much at the moment. I want to wait for the price to give me some signs here. Does this break through 1911? I think if that does, we make a pretty quick move down to 1877. So you're getting about 40 points of movement to the downside there. But you can see that we tried to make a low here. The buyers have stepped in, and we've just moved sideways here. So at the moment, so on the daily chart, on the weekly chart, on the 4-hour chart, the price is moving sideways. It needs to give us some sort of love. So maybe trade the range in the short term, but we'll have to see what happens in real rates. Where I'm actually seeing better action is coming through. Is in the currencies that are stronger. So the Aussie dollar's been on an absolute blockbuster, as we talked about. And if we're looking to short gold, you can do it in US dollar terms, as I say, but if you do it with Pepperstone, you can do it in alternative currencies. And the best way to try and get the best bang for your buck is effectively going long or going short of gold in the strongest currency. And we've seen that the Aussie dollar has been the strongest currency. So if we marry the two together, XAU, AUD, you can see that this is now trending beautifully. So if I'm going to go short gold, I want to do it in Aussie dollar terms at the moment. Obviously, the risk there is that we do see some profit taking in Aussie dollar, Aussie yen, and then that will take some of the wind out of the sails. But you can see here, this is trending lower. I've got the short-term moving averages, the 3 and the 5 day moving averages, the exponential ones moving a little bit lower, and that's defining the trend trend that we've been seeing. So we're seeing rallies into there, the market's selling off into there. We've seen this kind of bearish outside day reversal. The market's holding on at the moment, but I want to sell weakness. And the way we do is a momentum strategy is we're just going to take this down here. We're going to just take the low here. And if it breaks through these lows, I want to have sell stop orders. I want to take it through there and continue to ride this down. I think this looks good. We've seen the buyers, we've seen the market try and make a new high. It's failed. The bears have taken over, closed below the previous day's lows, called a bearish outside day reversal. So the bears are firmly in control of this. We want to just continue to take this momentum move. If it breaks through these lows, again, that will probably be driven most prominently by higher real rates and also a stronger Australian dollar. I think this can go down to 24.75, down to 24.50. Another currency which has been working quite well recently has been the pound. We're going into a Bank of England meeting fairly soon. I think there's a sort of 50-50 chance where we get a 50 basis point hike on that one. But let's have a look at what we're seeing there. The setup's really interesting as well. We've made this series of higher highs. We've broken the uptrend. We've retested it. Market didn't like it. Again, we've seen this bearish outside day reversal playing through these lows as well. So, that's a really interesting one. This looks like it wants to kick on down into 14.20. So for me, being short gold as a trade into 14.20 probably looks like the better of the pairs to look at. We can have a look at gold in Japanese yen terms, and we can see that going up. Why? Because the Japanese yen's been getting smashed. As I say, we want to be going long gold in the weakest currency, and that's been the Japanese yen. So whilst all the other gold pairs have been going down, because of the extreme weakness that we've been seeing in the Japanese yen, you've actually seen gold prices in yen terms going up. So that's an interesting one there as well. I will hold off a little bit from taking longs. Why? Because the yen is so oversold, and rightly so. It deserves to be oversold given the divergence you're seeing there. But that is one for the trend traders. For the rules-based traders, we look at this and say, look, Chris, it's going up. Stay long until you're proven wrong. And I have absolutely no problem with that one as well. But we've got a nice double top that continues to be in play there. I would be looking personally, despite my sort of fundamental belief that we're a little bit oversold on the Japanese yen. I think a break of 233,625 Japanese yen, again, that would probably mean we'd move up into 24. So that's a really interesting one. Let's have a look at gold in euro terms. Again, we're just holding in. There's a defined support level here at 17.28. So if we do see a stronger euro materialise, and we see those real rates continue to push back up towards zero, then I think shorting gold in euro terms would be probably a better place to be, rather than that dollar terms as well. But obviously that really depends on what happens in the euro, if we see some short covering playing through. So some really interesting opportunities playing through. We can see from those charts that real rates have been driving the show, and much more strongly correlated with the gold price. So we've got to take a view on what's going on there. We can see that in TradingView. I'm not sure if everyone else there has a Bloomberg terminal, but you can see those numbers there on TradingView as well. And in terms of the setups and the flow that we've been seeing, gold in US dollar terms going sideways. It needs to trend for me. It's consolidating. There's a battle going on between the bulls and the bears. Someone's going to win out. When it does, when it reveals, I'm going to go along for the ride. But the easier trade right now is being short gold in sterling terms, being short gold in Aussie dollar terms on a breakthrough through these lows, and also being short gold in euro terms when it breaks through 17.28. That to me is probably the easier trade at the moment in this market. Of course, if it does find support and pulls up and breaks through 17.62, that could be quite an interesting one itself. One thing I will look at very closely at the moment, which is getting a lot of attention, is what's happening in the yield curves. Okay, so gold could find some solace and some inspiration from what's happening in the yield curves. Now, we've seen the front end 2-year treasuries moving up quite sharply as rate hikes get priced in. And obviously we're very rich. We're pricing in nearly 8 rate hikes over by the end of the year. They're pretty full, to be honest. But you can see the difference between what's happening in 10-year treasuries and 2-year treasuries. That yield differential has been trending lower. And of course, everyone's now talking about an inverted curve. What does that mean? Is it just that the Fed are raising rates into a recession, or are they going to create a recession? What is the probability of a recession at the moment? I still think it's probably priced around 15-20%. But there are a lot of people out there who are saying that we are leading ourselves into a stagflation environment. Certainly that's the case in Europe, but maybe we could be seeing that more in the US. Now, gold could be a portfolio hedge against stagflation. I think it probably is a good place to have. So you may see more funds saying, forget about real rates. Let's look at more at the yield curve going forward. And if this starts to invert, certainly 2s and 5s, 2s, 10s, whatever part of the curve you're looking at, if it starts to invert, You could see people saying we're going to see a higher chance of a stagflationary environment, perhaps a recessionary environment going longer term, and gold could be a portfolio hedge against an impending recession. So I'll be watching the yield curve and how correlated gold gets to that at the moment. But what I'm seeing in terms of the flow, given the headwinds that we are seeing from the moves in nominal and bond and real rates, is that the sellers are getting the better say at the moment, and certainly in the pound, certainly in euro terms, and some of the stronger currencies we've been seeing, Aussie dollar, for example, there. So we'll check back in next week. If you like the video, give us a like. If you've got any comments, obviously leave a comment. It's very bond heavy, but we can see the reason behind that fundamentally is because the correlation with gold and the bond market has picked up quite sharply, and therefore, it's important to the market, it's important to me, and it affects my judgment. So something we are watching there as well. So a few setups that I like, certainly taking out the dollar and looking at other currencies at the moment. So good. Happy trading. I'll see you next week.